Ladies and gentlemen, good evening and welcome to the Q1 FY25 results conference call of Bajaj Auto Limited. My name is Sagar and I will be your coordinator. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the initial remarks from the management. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anand Newar, Head of Investor Relations from Bajaj Auto Limited. Thank you and over to you, sir.
Thanks, Sagar. Good evening, everyone, and welcome to Bajaj Auto's Q1 FY25 earnings conference call. On today's call, we have with us Mr. Rakesh Sharma, Executive Director, and Mr. Dinesh Thapar, Chief Financial Officer. We will begin our call with opening remarks from Rakesh for the business and operational performance for the quarter, and Dinesh will take you through the financial highlights. We will then open the forum for the Q&A. Over to you, sir.
Thank you, Anand. Good evening, ladies and gentlemen, and welcome to the Q1 earnings call of FY25. I thank you all very much for joining in. We hope to make it worth your time. I must begin by saying that it has been an outstanding quarter, and I think we beat the street estimates yet again, though by a small margin. Revenue from operations grew by 16% to finish just under 12,000 crores. Top-line growth was evenly driven by both domestic and export sales, and record-setting spare sales too. Spares now constitute 11% of our revenues. EBITDA at 20.2% crossed 2,400 crores, delivering a 24% growth. This is the third successive quarter of 20% plus EBITDA, and that too with a growing EV portfolio, two-wheelers and three-wheelers, which now stands at 14% of our overall revenue. In our previous call, while we have acknowledged the complexities and challenges in the environment, particularly in some overseas markets, we've also emphasized that despite all challenges, we see good opportunities for growth. Hence, our focus remains to drive top-line growth while maintaining best-in-class profitability. The results of this quarter are an outcome of this strategy. Going forward, we will continue on the same path and create more platforms for growth. Platforms which connect us with opportunities in the market and can be scaled up. The alliance with Triumph to attack the middleweight segment in India and overseas, and the e-auto or the e-three-wheeler development to attack the restricted three-wheeler market are examples of new platforms created last year. In recent months, we have brought to life 3 more such platforms: the CNG bike, the sub-1 lakh electric Chetak, and the new plant in Manaus, Brazil. These will give us access to new business, and we will be talking about them later while covering the SBUs. Export business unit. Overall, there is a small but steady revival in the overseas markets, and the number of countries which remain in stress conditions is also slowly reducing. Largely, it is Africa, which continues to underperform across almost all major markets, led by Nigeria. Though we have seen currency stabilization for the last few weeks in Nigeria, the substantial devaluation-led inflation has seriously dented demand. Our benchmark motorcycle sales in Nigeria of 50,000 per month has dropped down to under 5,000 in April, but has now recovered to 15,000 levels, still a far cry from the 50,000 benchmark. Compared to Q1 of previous year, we are down by about 40% in Africa, but up by 20% in Middle East and North Africa, up by 70% in Asia, led by Philippines and Nepal, and LATAM has delivered an outstanding performance with a 26% growth and reaching or crossing the benchmark of FY23 levels. While in stressed markets, we continue to roll with the market, which is largely Africa, but in the recovering and growing markets, we are significantly outperforming the industry and gaining share. The new plant in Brazil commenced production in June it has a single shift capacity of 20,000 units per annum, but that is scalable to 50,000 units per annum. This will make a quantum change to our capability to introduce new models and widen distribution. Traction for our Dominar brand has been excellent, and in the medium term, we expect Brazil to be amongst our top 3 international markets. Exports of Qute to Egypt commenced in Q1 with shipments of 500 vehicles, which will soon be on their road, opening up yet again a new segment for us. On this basis, we expect Q2 to be better than Q1, and will continue to be on a growth path in the exports business unit. Domestic motorcycles business unit, let me explain our performance in the 2 halves of the industry, the 125cc plus and the 100cc segment. The business maintained its strong position in the 125cc plus segment, which in quarter became 51% of overall industry. Our growing market share of 25% in this top half is just about 2% short of leadership. With 75% of our sales coming from the top half, the impact on both top line and bottom line has been significant. The major contribution in the top half comes from the top half of the top half, which is the 150cc plus segment, where market shares advanced to a solid 40%, driven by the substantial makeover of the Pulsar portfolio over last year. Capping it all with the launch of the biggest Pulsar, the NS400Z, which has been received very well, as reflected in the bookings of almost 2,400 units. Deliveries have commenced, and I think last month we have delivered about 1,000 units. Beginning last financial year, we introduced the N series, targeting the sporty commuter with a modern, easy-to-ride bike, and then went on to strengthen the high-performance NS series. Together, the newly launched and renovated N and NS series and the higher-end Pulsars account for 70% of our portfolio. This Pulsar portfolio gives us a great springboard for growth through increasing market share as well as by expanding the sports segment itself. Coming to the 100cc segment, which is the bottom half, you may have witnessed the game-changing initiative of Freedom 125, the world's first CNG bike, launched to an absolutely breathtaking reception. Not only is the proposition of 50% savings of the fuel bill very impactful, Freedom 125 styling, dual fuel capability, the range, ergonomics of the long seat, and the comfortable ride due to the linked mono suspension have all been highly appreciated. We are targeting the mileage-conscious customer in the 100 to 125cc segment. Of the approximately 1 million motorcycles sold per month in India, almost 75% are in this segment, the 100 to 125cc segment. And about 60% of this demand of these customers has access to CNG pumping stations. Hence, our addressable market is about 450,000 to 500,000 customers per month. We are targeting all these customers with the proposition of fuel economy, standout style, comfort, and assurance. Our market share in the 100 to 125cc segment is just 15%, so we naturally see a good room for new business. We are doing a phased launch, commencing with Maharashtra and Gujarat and then going on to Delhi and Kerala within Q2. A key enabling factor for the success of Freedom 125 will be the ease of CNG availability. And we are hoping that the CNG distribution companies will also take this opportunity to expand their business and facilitate the migration from petrol to CNG. This will be most helpful in upping the rate of adoption of Freedom 125. We are starting with a capacity of 10,000 tons units per month in quarter 2, but we are planning to take this capacity up to 40,000 per month by quarter 4. Obviously, with a bit of lead time, these capacities can be revised based on market response. It is early days, but I can tell you that the savings proposition, the style, the ride feel, and the comfort have all been very well received, and there is good reason to entertain the thought that freedom could redefine the motorcycle industry. Coming to commercial vehicles, the three-wheeler business unit maintains its rock-solid performance with an overall market share of 78% in Q1. In e-autos too, our market share increased to 26%, up 9% from previous quarter. From presence in 70 locations, we have expanded to over 140 in quarter 1, which should set us up for over 50% growth quarter on quarter in the E segment. The advancing CNG infrastructure, a solid presence in it, combined with the scale-up in EVs, particularly in markets not available to us thus far, will continue to drive solid top line and bottom line performance in our three-wheeler SBU and consistently breach the 100,000 mark per quarter. Chetak business unit. Chetak is now solidly in the number 3 position, though in billing terms we were at the number 2 spot in June. This was largely powered by the new Chetak 2901, launched at the price range of 96,000 to 1 lakh rupees. This will enable two things. It helps us to attack the sub 1 lakh segment, which is almost 50% of the e-two-wheeler industry, and will help us widen distribution. We were in 250 stores in June, should be in 500 by end July, and almost 1,000 by September. While our overall market share in Q1 was 12%, it should be noted that we were at 20% plus in the above 1 lakh segment, and obviously almost nil in the sub 1 lakh segment. Hence, play in the new segment, which is the sub 1 lakh segment, and in new geographies should combine and lift the Chetak business significantly. This will again add new business to Bajaj Auto. Continuing work at R&D and supply chain is ensuring that the cost profile is being constantly driven down month on month, and our growth plans take into account that an acceptable level of cost is being reached. Pro Biking, this BU houses 2 brands, KTM and Triumph, each with a dedicated network of sales and service. KTM continues with its steady performance. The recently launched new Husqvarna have appealed to the aficionados and are getting very good reviews. In Q2, the BU will commence promotion of the big bikes from KTM, and sales will commence from October, which should really strengthen the high-end, high-performance DNA of the KTM brand, casting a halo effect in the rest of the portfolio. An example is the recently concluded second KTM Cup, the largest one-make race. It reached an audience of 55 million with 900 KTM owners from 114 towns participating in it. In the Triumph business, as you know, we have 3 initiatives: scale up the domestic network to 150 stores in H1, develop the brand and offer a top-class differentiated experience, as well as support Triumph UK to successfully expand business in overseas markets. We are on track on all these. Triumph is now present in 100 locations, which allows us to undertake mass-level brand building initiatives for the brand. This is a very important initiative because as we expand, we are very conscious that sales will rise only once the Triumph brand gets to be better known and better experienced by the potential customers. Curated experiences like bike nights and marquee tours are steadily exposing the world of Triumph to bikers. This month, we actually completed a year of Triumph sales, during which over 60,000 bikes have been sold in over 57 countries, bringing a revenue of 1,200 crores to Bajaj Auto. The reception in both India and most overseas markets continues to be very promising, and with several opportunities for expanding the range and going for a larger play of the middle weight segment. Finally, a word on our captive finance company, BACL, which continues its rollout steadily with almost flawless execution. About 50% of the Bajaj Auto markets and stores have now been covered by BACL. We are on track to reach 100% by March 25. In conclusion, all the BUs have momentum, and building on last year's work, which created 2 new platforms for growth, this year already we have 3 more new platforms. So we are looking at a good 5 to 6 new growth platforms. We are positive and optimistic on this basis about the forthcoming quarters. Thank you for your attention, and with this I hand over to Dinesh.
Thank you, Rakesh. Good evening, everyone, and as always, thank you for joining us for this call. Let me say at the outset that we are rather pleased with our performance. We've delivered double-digit growth in all counts across our domestic business as well as the exports business, and on all dimensions of revenue, EBITDA, and PAT. In fact, we've come very close to the all-time highs that we achieved in quarter 3 of the last financial year. If you could recall, that was a large quarter for the industry, as indeed ourselves. It was the festive quarter. And so therefore, whilst that was aided by the typical seasonal upswing, we're quite reassured by this current quarter where we delivered nearly the same numbers in a quarter that does not have any of that advantage. And that clearly bears testament to the sustained momentum that the business is going through. Now, you've heard from Rakesh on the markets and the businesses, so I'm going to avoid duplicating that and get straight away into dimensions that we've not covered. So let me start with giving you a sense on what's happened on commodities. So on commodities, we saw a slight uptick on a few lines this time around. Aluminium, copper, rubber, and noble metals like rhodium and platinum were up. However, there was some relief as well, most notably from steel, but as much from nickel, lead, and palladium. This, along with the continued effort on cost reduction that we've been speaking about for some time right now, you recall we had emphasized this when we spoke to you the last time around, and it's held true this time as well. The cost reduction on the electric portfolio, along with the balance of the commodity basket, meant that we were able to hold the material cost impact in overall terms to be neutral for this quarter. Yeah, so neutral on material cost impact. Equally on pricing, it turned out to be a flat quarter in overall terms, as some price increases that we were taking judiciously on the ICE portfolio offset the price reduction that we took on the electric portfolio to drive its competitive growth performance. The investment was made particularly to sustain the momentum and our plans for expansion in a situation where the subsidy to the customer was reduced in the transition from FAME to EMPS. As for currency, it was steady and largely range-bound, with dollar realization at 83.4 this quarter compared to 83 in the previous one and 82.1 same time last year. And so if you bring all of this together in terms of what you've heard on the various businesses as well as this context, the quarter closed with revenues of 11,928 crores. We delivered 16% growth year on year on the back of robust vehicle sales and a record high spares revenue, which Rakesh just spoke about, the latter having crossed 1,300 crores mark yet again. This robust growth of 16% year on year is largely contributed half a piece between volume-led expansion and favorable mix, with a very marginal contribution coming in from realization. A rising proportion of sales of the higher-priced Chetaks, electric three-wheelers, Triumphs in the domestic market, and a richer sports-led mix in Latin American markets on exports are really the key drivers behind this mix improvement. Within the overall revenue performance, the domestic business registered its 9th successive quarter of double-digit growth, a reflection of its continued momentum and resilience, whereas exports at about $460 million for the quarter reported double-digit growth yet again. You recall we had reported double-digit growth in exports the last time around on a softer comparator. This time we registered double-digit growth of about 16% on the exports portfolio as well. Underlying these numbers and of particular note is our sure-footed progress on the electric portfolio. In FY23, the annual revenue from our electric portfolio, which was essentially only Chetak back then, was all of 500 crores. In FY24, with the scale-up in volume of the Chetak and the launch of the electric three-wheelers towards the middle of the year, we ended the year with 4x revenue of the previous one. So essentially, FY24 was 4x that of FY23 on the electric portfolio. As it stands now, that run rate has stepped up even further as we expand both Chetak and the electric three-wheelers. And you will notice in the press release that we put out earlier today, we've shared with you a new data point. In this quarter, a sizable 14% of the domestic revenue has been contributed by the electric portfolio, comprising both electric three-wheelers and electric two-wheelers. And many would say that we are just about getting started. Indeed, we are strongly committed to playing and investing for competitive growth in this space and expanding this business in multiples in the times ahead. EBITDA came in at over 2,400 crores, up a strong 24% year on year, while quarter PAT at 1,988 crores was at striking distance from the 2,000 crore milestone. Enterprise margin was maintained at the 20% levels yet again, and you will see in this a strong reflection of how we are managing the business dynamically for volume, competitive volume growth, and market share expansion whilst delivering profit improvement in tandem. At 20.2, the margin improvement of 130 basis points year on year was largely led by better realization and cost reduction. So it had elements of better realization and cost reduction that went into it, which really more than offset the drag from the growing e-two-wheeler business, which continues to improve on its economics, but is still some time away from adding to the bottom line. Sequentially, the margin has expanded by about 20 bits quarter on quarter, largely coming through from an uptick in dollar realization, while other pluses and minuses actually net out. A quick word on cash. The business continues to remain on the trajectory of converting profits into cash and building substantial surplus funds to fuel future growth investments. Our surplus cash stood at about 16,700 crores at the end of June, having added over 1,750 crores of free cash in this first quarter. From the free cash flow generation, apart from discharging the buyback tax that we did at the start of this quarter, we also infused capital of 505 crores into our capital wholly owned NBFC subsidiary, Bajaj Auto Credit, where, as you heard from Rakesh, we are making very good and steady progress on expanding its presence across the country, with nearly half of the business already covered and the balance half planned to be done before the end of this financial year. Our consolidated PAT, as I now refer to, was at 1,942 crores compared to 1,644 crores same time last year. The difference was the standalone results, which, of course, apart from making intercompany profit eliminations as per standard accounting policy, is on account of making early investments ahead of the growth and build-up of scale, on both BACL as well as for commissioning our manufacturing facility at the end of June in Manaus, Brazil. And that really helps potentially unlock supply constraints for us to leverage a large attractive market opportunity. We're enthused by the prospects of both these businesses, both BACL and Brazil, and expect them to add to our financial results in the near term as scale builds. Finally, as we look ahead to the next quarter, a few of our key priorities entail sustaining the momentum on our domestic business, which essentially is about driving competitive growth and winning in the upcoming festive season, staying the course on recovering our exports volume and gradually inching them up, expanding our capacity, capabilities, and network for our new businesses and launches that you just heard Rakesh talk about, Freedom, NS400, electric two-wheelers, electric three-wheelers, Triumph, building and developing strategic growth enablers through our wholly owned subsidiaries, which is on Bajaj Auto Credit and on Brazil. And lastly, of course, sustaining margin and managing the P&L dynamically given the context of rising commodity costs and potential investments that we will look to make behind building our new businesses and brands. The current outlook for commodities suggests that we could be looking at inflation in costs across a number of lines in this current quarter. Although most pronounced within each of them is on aluminium and copper. And to partly mitigate the probable cost impact that is looking to be anywhere in the range of 50 to 70 bips, we've taken a round of pricing at the beginning of this quarter, which covers about half of the estimated increase in commodity prices. Of course, it's still very early days in the quarter, and this could change. And therefore, we are watching the space closely given the many moving parts, and will decide the future course of action as the cost situation evolves. With this, let me hand the session back to Anand to open it up for Q&A.
Thank you. With this, we can open it for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Kapil Singh from Nomura. Please go ahead. Mr. Singh, your line is unmuted. Please proceed with your question.
Hello, can you hear me?
Yes, sir, we can hear you now. Please go ahead.
Okay. Yeah. Thank you. Good evening and congratulations to the management for continued strong performance. I first had a question on electric two-wheelers. I noticed that Chetak volumes have been ramping up quite fast, and one could say that pricing has become more affordable and that has helped, but competitors have also reduced pricing and some of them actually selling lower than your pricing. And yet, Chetak has been gaining share. So if you could help us understand what has been going right, and do you think there is potential to further rise up in the leaderboard to potentially number 2 position sometime this year with the new affordable model, or any volume aspirations by the end of the year that you would like to share?
Okay, thanks, Kapil. The rise in Chetak market shares and volume which you have seen, which over the last 12 months has been pretty impressive, is a combination of the fact that you also mentioned that we trimmed the prices and we have also expanded the network. We started with 40-50 stores only, and we were hobbled on the supply chain side because, and this I'm talking about, the closing quarters of the previous financial year, which is financial year 23. Once supply chain assurance was there, then we started to improve distribution. Then we started to also invest a little bit behind communication, and all that sort of went into the rise of market share. I think what the premium customers are appreciating is the build quality, the reliability, and the styling of Chetak. And also the fact that it is the only one which has got a metal body and an onboard charger. These are some of the differentiating factors which Chetak has, which is setting us up for growth there. But, and like you have rightly pointed out, a lot of action was initiated at the sub 1 lakh pricing level, between 75,000 to 1 lakh. This also has mopped up business from some of the smaller players which had entered earlier, which accounted to 45%, 50% of the business, which is now shrunk to only 15% or so. But what it has done is, we made very abundantly clear that there are the above 1 lakh and the below 1 lakh segment. And we were, of course, not participating in the below 1 lakh segment, which I said, because we didn't have a product. And now with the arrival of the 2901, it has put us in a very, because it is essentially the same robustness, reliability, and styling, which is slightly defeatured for the saving in costs and attacking that segment. So with that, we get a very good geographic play and a segmental play. And certainly our next stop is the number 2 position, and after that we will see how to move towards leadership.
Sure, sir. And if you could also comment on the profitability of electric vehicles, both two-wheelers and I think three-wheelers we have already talked about, but more two-wheelers because we have seen a significant pricing change and maybe costs have also changed. And if you could also talk about how much PLI we are accruing here. So this is one part. The other part is, we have also launched CNG technology here. So do you think that in certain cases, CNG may be more viable, for example, in motorcycles than the electric vehicles? Or maybe you think CNG is viable in scooters as well. What is the product pipeline on CNG? Will you gauge performance and then look at more products, or there are already more products in the pipeline?
So our analysis was that the CNG would appeal to the longer distance rider, which when I'm saying longer distance, it is people who ride 30 kilometers plus. If you see per day, there has been a little bit of stagnation in the growth of the electric two-wheeler segment because it is largely sort of addressing the short distance commuter. The longer distance commuter is shying away from it, the inter-town travel and all that. And therefore we see a CNG as a better fit in the motorcycle format, which allows the customer to, allows the rider to ride, very long distances. And the electric, where still range anxiety, charging, etc., remain issues and barriers to growth. That fits in better in the scooter format, which is generally multi-use, convenient use, and smaller, shorter distance riding. So these are the formats. But I must tell you that from the early indications, there are some scooter customers also who have considered the CNG bike. When we have put out these three models, obviously we have designed them on the basis of a platform. And this platform can spawn on both sides, on the higher end side and the lower end side, newer variants beyond these three. And we will, of course, see which is the right time to introduce those. So yes, Freedom is actually a portfolio brand, and it's not just a product brand.
Okay, coming to your question on profitability, not very different in terms of position from what we outlined in the last quarter. So let me get the electric three-wheelers out of the way. No different from what we've told you in the past. It continues to be profitable at a margin level parity with ICE three-wheelers after considering the PLI benefit. And so to that extent, very profitable. I'll comment on PLI accruals in just a bit. On the electric two-wheelers, of course, it continues to be a drag as you would expect. But I think what is now working for us is that the cost reduction effort that had been mounted and the program that had been mounted for some time now has started to deliver. And so in many ways, the expansion of Chetak that is now happening is not coming in at an incremental drag. The drag that has been there in the base continues to sustain. And so a lot of the cost reduction effort is going behind funding for lower pricing and for potentially lower priced mix. Right? So no additional drag coming in from Chetak expansion, nor from the price drop that we may have taken. to remain competitive in the market. But the larger drag and the fact that it is not yet profitable and will still take some time is no different from what we may have outlined the last time around. In terms of PLI, yes, we have accrued PLI for this quarter. We are accruing for it. You know that the cash cycle might play out much later. The SOP and claim submission is still in the works, and so therefore claims have not been submitted as yet. We will get to know that as the authorities put that out in the future. But recognizing that we now have a certified vehicle by the testing agency, which is what I had mentioned the last time around, on the 5 vehicles that we have in the electric portfolio, 2 of which are Chetak and on electric 3-wheelers, we now have certified DVAs that are certified and signed off by the testing agency, which essentially make us eligible for PLI. And so therefore, to that extent, we have accrued for PLI in our financials for the quarter. Right? At the moment, the new introduction of the Chetak, which is the 2901 that Rakesh just spoke about, the DVA certification with the testing agency is currently underway, and we expect that to come in anytime soon.
Sure, sir. Possible to quantify the PLI amount you have accrued?
Well, I mentioned to you it is 13% of the sales as per the PLI eligibility. So that's really the level at which we recognize it.
So, thank you. I'll come back in the queue. Thanks.
Thank you. The next question is from the line of Gunjan Prithyani from Bank of America. Please go ahead.
Yeah, hi team. Thanks for taking my question, and thanks for the comprehensive remarks on all the businesses. Pretty useful. I just wanted to touch base on the 2 new opportunities or platform for growth that you spoke about, particularly on 3-wheelers. Now, is it possible to get a sense of what percentage of your domestic 3-wheeler volumes are now electric? And also, when you talk about this 30% market share, what is the magnitude of market coverage that we have already in place so far with the distribution network? And then extending a little bit further, just the business expansion on the electric 3-wheeler side. The initial thought process was to target the markets where there are license restrictions and then go to markets where CNG is not an option. But is there something that we're looking to tap into the e-rickshaw market as well, because that continues to become very sizable portion of the 3-wheeler market in itself?
Thanks, Gunjan. So, we sell about 33,000 3-wheelers, out of which about 3,000 from the latest month is about are the electric 3-wheelers. So that is about 9-10% of our portfolio is there. Like I mentioned, we are in now about 140 towns, and this is giving us almost 70% coverage of the e-auto market. Our priority was to go into markets where we could not have gone with the CNG 3-wheeler or any other 3-wheeler due to permits. And these were largely in the North, Uttar Pradesh, and to some extent in the East. So we prioritized our action over there. But we are very clear that it is an all-India play, and we certainly don't want to lose, be a late entrant in any market just because we are selling a CNG 3-wheeler there. So there is no thinking like that. When we had supply chain build up, we said that let's first attack the virgin markets and then come to an all-India play. But we are very clear that there is no reason for us to not put in a electric 3-wheeler where a CNG 3-wheeler already plying. And one of the things which emboldens us, which is what I mentioned a couple of quarters back, that we are margin agnostic. So if there is any cannibalization, it is not really detrimental to the company. Having said that, I must also point out that the case for electric 3-wheeler opposite the CNG 3-wheeler is not so strong. And whereas people migrate very fast from diesel three-wheeler to CNG three-wheeler. People are actually migrating from e-rick, which is far cheaper, from an e-rick to an e-auto. That phenomena also we have noticed. And these e-ricks are largely there, as you know, in north and east. And as we have grown our share in some places in the north, we are reaching 60-70% share already. That share is of the total market, and it includes a lot of e-ricks, particularly end-of-life e-rick, which is, let's say, 2 to 3 years. So if there is a e-rick owner who is been flying a lead-acid e-rick for about 2 or 3 years, it's absolutely hot target for us to convert all the way up into e-auto, because they know the patterns of traffic, that is a source of income. We just want to move on from e-ricks to a more substantive format. So that is why I'm saying that the e-auto, even if we place it all India, actually gives us far better traction in those markets where CNG is not allowed and where e-rick is already flying.
Okay, got it. And we don't see a case to have a product which is at a lower price point to accelerate this upgrade from e-rick to three-wheeler auto, maybe a limited range product, because the range that we offer right now is quite good for a electric three-wheeler auto, but maybe the e-rick category doesn't need that sort of range and allows us to bring down the price point. So is that something that, from a product expansion perspective is can be explored?
Very much so. Actually, the strategic shift which we have made for some time now is to now look at the market size through the lens of three-wheel mobility. Earlier we used to be saying that we are in the auto business when we have an 80% market share. But actually we don't have an 80% market share because 43% of the market today is e-ricks. So we are actually 80% of 50 or 60%. So we are very conscious of that. And just 40% we feel, frankly speaking, is something which has just been allowed to mushroom. It is a substandard product. It is, if today we were to apply a PLI kind of a rigor to it, it will not pass BBA because a lot of it is imported. And we are conscious that it fills a certain need of larger passengers carrying capacity over shorter distances, and development is very much in the card. So we know that we will have to extend our three-wheeler portfolio to address the needs of that segment also. And therefore, in conclusion, I would just say we want to be a full range player in the full three-wheeled market. All fuels, all CVs.
Okay. My second question is on Triumph. Now, both in domestic and export market, the volumes sort of are in the range of 2,500 to 3,000 for the last 2-3 months. I think 6,000 is where we are averaging for the month. Now, how should we think about the ramp up here? Maybe if you can share a little bit color on how the acceptance of the product has been in export markets, because this is sort of a wide space in export markets. How does that scale up over time? Both domestic as well as export total Triumph volume contribution that we can, we are expecting going ahead.
Yeah. So the first phase in the exports market, which is of course mostly almost entirely managed by Triumph UK, was done with the objective of pipelining. There was very long pipeline with product being placed in 57 countries and each having its own homologation and specific requirements. So the whole thing was to just place the product and fill the pipeline. That phase is over, and of course retail has commenced in most of these places. And the reports which we have got from Trans UK is that it is met with a very good reception and much better reception in geographies like UK, continental Europe, and and a decent reception in places like North America and ASEAN. But really, they are now they are pausing and looking at the flow of the retail level and keeping the next phase just adequately stocked up. The retail chains are adequately stocked up. Once the retail flows are better understood, I think we will see again an uptick in export. But this is that phase where retail patterns are being observed, which hopefully in a couple of months' time should get to be quite known. In domestic, we are at about 2,000 unit level per month, as you know, over the last 2-3 months. There has been a substantial expansion of stores which has taken place, which has taken our stores from 40 to 100 in the last couple of months. In these new markets, the challenge and the task before us is to really build local awareness. And the kind of awareness which is there for Triumph in, let's say, metro like Bangalore or Pune, Hyderabad, these kind of places, is vastly different from what it is there in a, let's say, a Coimbatore or in a Dehradun kind of a place. And therefore, now the challenge is shifted to building local awareness of what is Triumph heritage, what are the products, the modern classics, as we are calling them, and what it means to be part of the Triumph world in terms of the ride experiences, etc. And this now we have embarked upon in all these places, and hopefully over the next 3 to 6 months, I think we will come to some decent levels of awareness, which will then allow the sales through these newer stores and geographies to rise up and start to become significant.
Okay, I'll join back the queue. Just one request, if you can also share the market geo contribution for the various export markets like you usually do, for us to have a sense how big Nigeria is, the salience of Nigeria, and what is Brazil as of now. It will allow us to think about growth across various markets then.
Okay, so yeah. Rajan will take it up after the call.
Okay, all right. Thank you so much.
Thank you. The next question is from the line of Binay Singh from Morgan Stanley. Please go ahead.
Hi team, thanks for the opportunity. Could you share how do you account for PLI incentive? Is it in revenue? Is it in cost? Is it in EBITDA?
So Vinay, it's accrued for in revenue, and by virtue of accruing for it in revenue, it flows in through all the way into EBITDA as well.
And this is the first quarter that you are accounting for PLI incentive?
Yes, because if you recall the last time I mentioned, that was when we had just about received the certification from the testing agency for DVA. So this is really the first quarter of
if we just add up the information that you shared, that 14% of the revenues are electric, and we understand 5 3-wheeler models and 2-wheelers get the PLI, then broadly it sort of leads to almost a 70-80 basis point of margin support coming from PLI incentive in this quarter. Is that a fair assessment versus last quarter?
It would be under 50 bits of contribution.
And I think another thing from your 10% mix number points out that almost 60% of your domestic EV revenues will actually be 3-wheeler. So I think this is one differentiation, which is why EV is not becoming a drag so much to you. versus your peers. Will that be a fair statement?
Sorry, the line was slightly garbled, Vinay, but is your question saying that the presence of electric three-wheelers will contain the drag on our results?
Yeah.
Yeah, no, absolutely. Sorry, go ahead.
Because to be a 6% of your domestic EV revenues, right? With the numbers that you shared, that 9-10% of domestic two-wheelers are electric, which means that almost 60-65% of your domestic EV revenues will probably be three-wheelers.
Okay. I'm not getting the construct because I think it's also because the line is slightly harsh, but you can pick it up with Anand. But let me just reiterate what I mentioned. I mentioned that 14% of the domestic revenues in this quarter have been contributed by the electric portfolio with two-wheelers and three-wheelers put together.
Right. No, I'll connect with Anand. And lastly, just any comments about industry volume growth? And we've also seen Bajaj Auto losing some market share. So any comments on how you see industry volume growth shaping up and your market share within that? That's it from my side. Thank you.
So the industry outlook, as we said, we think should be 6 to 8%, and the top half, the 125cc plus segment will grow much faster, and I think we will grow faster than the industry in the top half. The bottom half, as you can see over the next 6 months, largely, the big move over there is with the Freedom 125, which definitely will add to the market share, which is being maintained. Your comment about there is no loss of market share, on your comment on market share, the blip you may be seeing is when you compare Q1 to Q1 of this year. Q1 of last year was a bit of an unnatural thing because one of the major players had faced issues in transitioning to the OBD2, and there was a big supply interruption in that quarter, and that has led to a very unnatural increase in market share for all the other players, including us. But if you look at it normalized, that was a one-off thing. Those market shares got corrected in quarter 2 of last year. And since quarter 2 of last year, quarter 3, quarter 4, and now quarter 1, we've been chipping away at the top half, and market share has actually been increasing. There is a slight loss of market share in the bottom half. Therefore, which was something which was expected. We have not participated in the sort of red ocean game which has been played in the mini season in the first in the north in the first quarter, particularly in April, May, and that has led to erosion of market share at the very bottom end. At the entry level product which we have, as you know, is P300 and Platina 100. So therefore, when you put these two together, a steady market share in the top half, but a slight erosion in the bottom half, you see some decimal points of market share being lost. But in the top half itself, sequentially there is a market share improvement.
Great. Thank you.
This is based on Vahan retail, I must just clarify.
Yeah.
We don't talk about billing market share. All my comments will be based on data from Vahan.
No, thanks for that, team. Overall, very good performance. Thanks.
Thanks, Vinay. I just want to be sure, my colleagues over here tell me that I think what we've gathered about your question was what is the contribution of the two electrics in the overall 14%, 60% of which comes from electric two-wheelers, 40% in the quarter has come from electric three-wheelers. The two put together therefore add up to the 14%. If that was your question, I just wanted to be sure everyone gets it. But if it wasn't, then Anand would be happy to engage with you offline.
Thanks, team. No, that's very clear now. Thank you.
Thank you. The next question is from the line of Mumuksh Mandlesha from Anand Rathi Institutional Equities. Please go ahead.
Thank you so much for the opportunity, sir. Firstly, can you share the CapEx guidance for FY25 and which areas of spend would be there, sir?
So, Mohammed, your question on CapEx guidance, we fall are very different from what I said in the past. It should be in the range of between 700 to 800 crores. A large part of that will primarily go towards the commissioning of our new electric three-wheeler facility in Bajaj and other capabilities that we are building essentially for electric. That's the chunk of it, but assume that it should be in the range of between 700 to 800 crores for the year.
Got it, sir. And so in this quarter, we've seen other expenses have grown strongly. Can you explain what could be the reason for the increase, sir?
Yeah, so there are 3 or 4 contributors to the other expenses. It is at par with what you would have seen last year, but it is fundamentally on account of, therefore we are seeing a step up between same time last year and now, and that step up is essentially driven by about 3 or 4 factors. The first is the heightened level of CSR spend this year compared to last year, which one has to keep providing for in the quarterly results. The other is the step up arising from variable costs and packing to reflect a step up in the volume and activity levels that we have. The third is some costs that we are incurring now for extended warranty on our electric portfolio, and as that is now growing over same time last year, those costs sit within the other expenses line.
Okay, sir. So lastly, how are you seeing the partnership with Yulu? Currently, volumes are around 1,000 units per month. How do you see the potential ahead from this segment in the EV?
Yeah, so I think the partnership, you're aware that we have an equity ownership of a little under 19% with Yulu. Clearly, they're looking now to expand volume. So what you've seen in this current quarter was essentially a little bit of the stock adjustments that they were doing to really rebalance numbers across the cities that they're operating with. We expect those numbers to step up in the current quarter from the early indications of plan they've given us. So very much committed to that business, and you're aware that the vehicles that we supply to them are essentially custom built. The platforms being built by us for them.
Got it, sir. Thank you so much for the opportunity.
Thank you. The next question is from the line of Raghunandan NL from Nuvama Wealth Management. Please go ahead.
Congratulations on strong results and on the CNG launch. Wishing all the best there. Firstly, on the CNG side, you indicated 60% coverage. Hello?
Yes.
Yeah. Firstly, on the CNG side, you indicated 60% coverage in the addressable market. Can you talk a little more on how well the coverage is or how deep the coverage is in rural and semi-urban areas? Also, when we do channel checks with dealers, ours is a small set of dealers, and they indicate that bookings have started coming in from customers and dealers are quoting 1 to 2 months kind of waiting period. If you can provide some color on initial bookings, what is the customer mix? And finally, on CNG again, when should we expect the variants, that is 100cc motorcycle, 110? How do you take it forward?
So CNG is available in 335 towns out of the 500 top towns, and these 335 towns account for 70% of the market. When we took 60%, we have bottom sliced some of the towns where the density is very, very low. But the density numbers are really very varying depending on the town, and very difficult for me to give you one number which will help you appreciate what is the depth we are talking about. At the one end, you have a city like Delhi, which has 550 petrol stations, but it has 250 only CNG stations and another 400 or so shared with petrol. So you can see that Delhi city has actually got the same penetration as petrol, gasoline, diesel station. And then there are others where there is only one CNG station for the entire town. So very difficult to give you. There are intermediate solutions also which the gas distribution companies deploy, like sending tankers, CNG tankers on regular intervals, which then goes and fills the tanks at remote locations and all that. So it's a very, very complex thing. Only thing I can tell you is that our initial meetings with the gas distribution companies have been very good, and they are very enthused that there is a new segment developing for them because it helps them push more throughput through their infrastructure, and their whole performance depends on how much they can sweat their infrastructure, because there's a big capex involved in putting up that infrastructure. So their stance, we are expecting, as we speak, we are having these local level meetings, and we are optimistic that our customers will be given, dedicated filling points, even in petrol station, in gas stations which are shared with petrol. And there was something
color on the bookings and customer mix.
So the bookings are right now about 4,200. I mean, this is yesterday's figure. 90% of this has come from Maharashtra and Gujarat, because we've opened up all India bookings to just a couple of days back. So almost 80-90% of these bookings are Maharashtra and Gujarat. Most of these bookings are actually for the top end, which was, the 110,000 LED headlamp disc, overwhelmingly for the top end. The deliveries, the dispatches are just about commenced. So we, I think, dispatched just about 100 vehicles or so. And the retail, the first retail happened, I think, a couple of days back. The type of customers we are still mining their data, but from whatever we have early analysis which we've done, it is very difficult to establish a pattern, because people from very different walks of life, whether it is demographics or whether it is geography, I mean, when I say geography, within Maharashtra, rural and urban, we have got a very broad spectrum of people who have come. So it's very difficult to see the pattern. But in a way, it is very good. It is showing that the appeal for the bike is cutting across several demographic and sociographic segments.
And when should we expect 100cc motorcycles, sir, in CNG?
Yeah, sorry, I was just saying that I'd already talked about that this is a platform and is extendable in both directions. But exactly when we are going to introduce a variant, we will see. We will watch it. It's not a ground up work which will be required. It's a platform, and very quickly we can respond if there is a requirement emerging in the marketplace.
Thank you, sir. To Dinesh, sir, if you can share on the e-two-wheeler, how would be the gross margin currently, including the PLI, considering the battery cost reduction and other cost reduction efforts you spoke about? Would it have come to double digits now, 10 to 15% gross margin?
So, at this point of time, obviously for competitive reasons, Raghu, I'm not going to be able to share with you the margin profile of the electric two-wheelers, but let me reiterate what I just said. I said that, Chetak is expanding. There is an inherent drag that, it is loss-making at this point of time, right? Clearly, the falling prices has only had an even bigger challenge on the economics. But I think what has come to our rescue is the fact that the cost reduction work stream that had been put in place has now started to deliver. In the last 2 quarters, whatever price drops we've had to take, or whatever volume that we have expanded, the incremental impact of that has been neutralized by the cost reduction. So there is a drag because the overall proposition itself does not make margin compared to the enterprise margin at 20%. But typically with an expanding volume, that strain on the enterprise margin should start to show up. We've been able to contain that on the expansion volumes by virtue of the cost reduction. Right. As far as the specifics of the margin profile, won't be able to give you a specific count on that at the moment, but to say that profitability is still a while away on the electric two-wheeler.
Got it, sir. Just lastly, some housekeeping. If you can share the electric three-wheeler volume for the quarter, spares number in crores, and the financing ratio.
Yeah, Raghu, we'll take these questions offline.
Sure. Thank you so much, sir.
Thank you. The next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Hi, sir. Quick question on Slide 125. You indicated that the addressable market is about 400 to 500,000 units per month. In that context, the capacity which we are looking at by year end of 40,000, is that quite low, or this can be scaled on a very short notice?
Yeah. So obviously, before we ask different types of vendors and all that to put in the capex, it is very important to get a good fix on the adoption rate. And the first step has gone off extremely well. We were confident of the proposition, but what we are very heartened about is also that the styling, the ergonomics, and the comfort, and all those things, the biofuel capability, have been also extremely well appreciated. Now we will see how the pattern unfolds in Maharashtra and Gujarat, and we will start to take some view on future capacity. I guess if we have that kind of a runway of about 6 months or so, we will be able to substantially expand the capacity. The key factor over there really is the CNG tank. That is the critical.
Got it. And secondly, on Triumph, if we look at the demand in the domestic market, especially markets where product has been launched, since launch, where product has been available, are you seeing any trends in terms of how demand is shaping up, how inquiries have been doing in the markets where products have been available since day one?
Yes, in the markets, in the metros and mini metros, we are finding very good traction and very good post-sales satisfaction, etc. Because these people come with an understanding of the lineage of Triumph, and that has been very, very helpful. However, when we step out of the mini metro area, the understanding of the Triumph brand and where this is coming from is rather limited, and that is the point I was making. That it's almost like two very different worlds, and the challenge now, or not the challenge, but let's say the task now is before the marketing team to various devices, whether it is rides or digital or local activation, to bring the brand to life. But in metros and mini metros, yes, particularly in the city centers, etc., it's very good. Now, even in a metro, let's say if you take a Bombay, Bombay is a very good brand awareness, but if you go to a Thane or if you go to, on the other side, to Virar or Borivali and to the real suburb, the brand awareness is there, but the detailed understanding of the brand, that has to be brought to life.
Got it. And Dinesh, on the staff cost side, we have seen a good increase on YY and QOQ basis. Any one-offs there which will normalize, or this is a normal variable increases which have happened?
Sorry, you'll have to repeat that because
the staff cost has seen a good increase on YY and QOQ basis. Any one-offs to call out there, or this is normal increases which are there?
No, I think the staff cost you will see is not very different quarter on quarter. So the year on year is a reflection of fundamentally increments and additional staffing for capabilities that we are building within the business. So nothing one-off that we need to call out.
Got it. And lastly, what were the export revenues in the quarter?
460 million orders.
460. Okay. Thanks a lot. All the best.
Thank you. Sorry, just before we take the next question, I know Raghu had asked the question on those three. I just want to be sure that these data points are accessible to everyone. So Raghu, whilst we won't get you back onto the queue, but the three data points that you asked for is the electric three-wheeler volumes in this quarter are fundamentally about 9,350 odd. The spares revenue at the moment is about 1,350 crores. And the financing penetration for motorcycles was 75%, and for three-wheelers was 90%. Yeah, we can get back to the question queue.
Thank you. We'll take the last question from the line of Pramod Kumar from UBS. Please go ahead.
Yeah, thanks a lot for the opportunity, Rakesh and Dinesh. First on the Freedom 125. Just wanted to understand the thinking here as to what will be the volume level the full ramp up is done, which will kind of satisfy you on the kind of success what you were looking for, because it's indeed a big differentiator. I don't think any OEM is planning anything like this anytime soon. So you really have a pretty good edge here. And as you said, CNG makes a lot of sense for most of the consumers, if not all. So what kind of volumes, given the kind of innovation what you put on the table, would be short of, will be like beyond which, or if you don't get that number, that will be something which will not very satisfactory. If you can just help us understand. I'm not looking for near-term volumes. Once, let's give it a year or so. Where do you think the demand will settle down?
See, like I said, our market share in the bottom half is 15% odd, and we would definitely be looking at a very respectable market share. The market share in the top half is 25%, and if we are getting to that kind of level, even in the bottom half, and when I'm saying bottom half, it could either be through upgrading them into the 125cc segment or just keeping over there. But if we can take that kind of a slice out of the bottom half and bring it up into the top half, and therefore climb to a market share of 40 to 50%, which indicates strong leadership of expanded top half, we would be very happy with that.
Yeah, thanks for that, Rakesh. And second question is on the premium category, Rakesh. We have seen, of course, Triumph and even Harley's launch kind of not do as great as what anyone thought or their management thought. Even Royal Enfield volumes have not been that great in retail front. So for the last few months, looks like the premium category is not doing as good as what one would have seen in terms of broader trends of premiumization across most of the other automobile categories and even outside of autos. So if you can just, is there anything which you're noticing there that, despite the multiple launches from industry participants, the category is not exactly kind of really benefiting from the premiumization trend, which is broadly seen across many parts of the economy. Any thoughts there?
Yeah, I think that piece has to be, you're Your observation is very correct, but that we are finding that the premium category of, let's say, the middleweight 250cc to 500cc has been a bit lackluster in performance. I would say that, and this is despite some of the launches by us and a few other people. So there's been a lot of action. But I must say that that action has a lot of it has been in the performance end of it.
Okay.
And I always find that the development of a category to a large extent is dependent on a player who has got a overwhelming presence on it. So we found that to be happening if you see in the 150 to 250cc category where Pulsar was ruling. And there was a time 2-3 years back when the pipeline was dry and we were seeing a shrinkage of the category. But now suddenly you see that the sporty commuter, the 150 to 250 has suddenly started to pick up. For quarters we couldn't sell 250cc, but last month our new N250 sold more than 1,000, retailed more than 1,000 units. So we are seeing certainly a traction over there. I guess there is a little bit of fatigue probably because of lack of action on the classic side. But hopefully it will correct itself.
And Rakesh, is there a play of the pricing also playing its part? Like what you see in 150 kind of lose out to 125 to an extent. Also, of course, people have upgraded from 100. But similarly, are we seeing that some of the potential 350 customers or 250 plus customers are now kind of settling for a more attractive package or product in the 150 to 250 category? Are we seeing that bit of down trading to an extent because of the affordability or the price escalations what you're seeing?
No, I won't say that. I don't think that within a brand, if there has been a lower priced variant which is almost very similar to the higher priced variant, you might be seeing a certain migration. But for a migration to go from, let's say, a 350 or a 400cc down to a 160cc is a little bit difficult to imagine. It happens a little bit, but I don't think in a significant manner.
No, that's very good to hear, Rakesh, and thanks a lot, sir, and wish you all the best. Thank you.
But one thing, if I may add, the NF400, which was just launched, that has clocked almost 2,400 inquiries. So it is probably the most successful initial launch, at least, the Pulsar NS400, which recently got launched. It is done extremely well. We have to see how long the trend persists.
Wish it continues, sir. Thanks a lot. Thank you, and best of luck. Thank you.
Thank you.
Thank you. Ladies and gentlemen, we will take that as our last question. I would now like to hand the conference over to Mr. Anand Newar, Head of Investor Relations, for closing comments.
Thank you, Sagar. Thank you, everyone, for joining the call. I'm open to taking questions 15 minutes from now. Thank you.
On behalf of Bajaj Auto Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.